Okay, well, good evening, everyone. My name is Adrian Day. I am the co-host of On the Move webinars, which was started and sponsored by my friends at ASI. My co-host is Rich Checkan. He's the president and COO of Asset Strategies. I've known Rich for, I don't know what now. I say this every month, but I keep forgetting. 20 years or more.
Yeah, I'd say about a quarter century.
So. Yeah, and how that sounds longer. Don't say that. And I've known your uncle and the founder of ASA for nigh on 50 years, so yeah. Half a century.
Yes.
So anyway, recommend the firm highly, and let's just pass it over to Rich to do the introduction of our very, very special guest.
All right. Before we get there, just a little bit about Adrian. He is very modest, but he is a graduate of the London School of Economics. I always like saying that. He wrote his own financial newsletter for many years. He's been an author. He is an author of several books, bestsellers. My favorite is the one on resources, investing in resources. I highly recommend it to anybody if you haven't read it yet to do so. He's pretty much been on every media outlet you can think of. He's in demand on the circuit. He is the owner and founder of his own asset management firm, which specializes in global and resource stocks. And he also is the brains behind the Europac Gold Fund. So a pretty accomplished gentleman, and I'm honored always to be in his presence. As I am honored to be in the presence of Dr. Nomi Prins here this evening, who joins us. Adrian and I have been looking forward to this for some time. For those of you from Adrian's world or my world that don't know Dr. Prins, give you just a little bit of background. I'm going to have to cut out a few things because we only have an hour and a half total, and she's done quite a bit. But she is a macroeconomist or economist, geopolitical financial expert, best-selling author and founder of Prinsights Global. You can find that on Substack. It's a geopolitical, financial, and macroeconomic analysis company. She's held key positions on Wall Street to include managing director at Goldman, senior managing director at Bear Stearns in London, strategist at Lehman Brothers, and an analyst at Chase. She's a board member of Rare Earth Elements mining company Meteoric Resources, and she's on the advisory boards for National Infrastructure Bank and Ethical Markets. She's the author of 7 books. Few of them just jump right out at me. I think everybody's familiar with Collusion, All the President's Bankers, and Permanent Distortion, among others. She received her BS from SUNY Purchase, her master's in Statistics and Operations from NYU, and her PhD in International Strategic Studies with an international political economy specialization from the Federal University of Rio Grande do Sul in Brazil. Dr. Prins, it is absolutely our pleasure to welcome you tonight to On the Move.
Well, thank you guys so much. It's really an honor to be here with you. Your backgrounds are incredible, and the fact that you've known each other so long is just such an important part of growing what we look at from an investment perspective and just a knowledge sharing perspective, as well as you guys being good people. And I'm glad that I also have known you not quite that long, but for many years. And I'm really excited to be here. And thanks to everybody who's joining here tonight.
Yeah, well, welcome one and all. We're going to get right into it. We've got a bunch of questions we're going to cover, and as you can probably imagine right now, gold, silver, the dollar are kind of on people's mind. I'm not sure why. It could be 27, 28 all-time highs for gold this year. I'm not sure. But let's talk about that. Gold has rallied to historic highs. We've seen, 27 to 29 of those here in the U.S. Depending on your currency, you may have seen 1 or 2 more or less, all-time highs this year. And yet, Dr. Prins, you say that now is a great time to add gold, to diversify your portfolio with gold and gold mining stocks. I tend to agree. I'm just wondering why you say that at all-time highs. Aren't you supposed to buy low and sell high?
Yeah. You're supposed to buy what's going up, to summarize, as opposed to necessarily knowing where low actually is. And yes, it's true, we have had so many records that have been broken in gold this year relative to the dollar and of course many other currencies. And there have been a lot of reasons for why we've gotten to this point right now. And we can talk about them in more detail, but basically they run from having been an initial sort of old standard gold positioning as an inflation hedge when inflation started rising in 2022 or into 2022, and the Fed started raising rates in 2022. But that was just a little bit of an increase, and then there was some decreases, so things were bobbling around. Then it's of course a wealth preservation precious metal as well. Then we started noticing a number of things happening in the last couple of years, which have culminated in these record highs this year, which is that geopolitically, gold has become something more than just its history, something more than just a currency diversifier, which it is, more than just an inflation protector, which it is, more than just a way of preserving and augmenting wealth, which it is, but it's become a geopolitical entity and asset in and of itself. And that's one reason why we've gotten to all these smashed records this year. And it's the reason as well that we're going to blast past these records in the years to come. If we just look at the central bank component of buying, and I know that is a story that some people are familiar with, but really to dig into some of the details of that, because that's integral to where we're at now, where we're going to be going from a geopolitical currency diversification basis. If we look at the largest holder, for example, or was the largest holder of US Treasury securities, dollar securities, which was the People's Bank of China, which used to hold $1.3 trillion of US Treasuries, which was only not too long ago in 2014 through 2018. Since 2018, they basically sold half of those as our debt has escalated, and they have basically replaced a portion of that with gold. They were the largest gold buying central bank last year. They hit their own record last year. This year they've stepped off a little bit, but there's reasons why they're coming back in. And they only still have 5% of their reserves in gold. That is actually low, even though they were the top buyer of central banks and gold in the world. 5% reserves are actually quite low. If you consider that Russian reserves are in double digits, Polish reserves are in double digits. The United States, which doesn't really reserve them, but owns old gold, has a significant double-digit percentage. So China, when you look at its escalation in gold purchasing to diversify politically, geopolitically, and from a currency perspective in gold, it's nowhere near where China, the People's Bank of China, and emerging market banks basically throughout the world want to be, but particularly China. So that is a main portion of buying and of just shifting geopolitically where the center of reserves are from a central bank perspective, and also how gold is really the leverage for international trade. The BIS, Bank of International Settlements, which is the central bank of central banks, just basically reinstituted the idea of gold being a tier 1 asset. What does that mean? Gold can be used for many more international purposes. This is recent. So these are all things, China continuing to increase and needing to, all the other central banks diversifying from the dollar, the geopolitical risk of basically holding those dollars internally throughout the financial systems of other countries, as well as their central banks. So there's a lot of things that are shifting that have gotten us to this point, but that are not going away. They are only growing. And there's one final thing, but I'll stop for a second in case we want to kind of unpack some of that. That's really also going to magnify this increase.
Sorry, say it again. The last sentence.
I said that there's one other thing that's really going to magnify this increase, and in gold purchasing, and that is having to do with international other buyers of gold. Central banks, despite everything I just said, and that we know and that we're seeing, are still only really active in about 15% of the gold that's out there that's mined in the world. That doesn't include gold still under the ground, gold that's in projects and so forth. Even as it has escalated the prices and will continue to do that, it is only a small portion of gold buying out there. If we consider that from an alternative asset standpoint, more retail is getting into gold, particularly in those countries, right? So a central bank goes to gold. The financial system will go to gold. That means banks in those countries which have yet to stockpile gold will start to do it in reflection to what the central banks are doing in those areas. And then you've got the retail side. The biggest retail buyers in gold are into the gold ETFs in China. So there's a global basically pivot to gold, which has really just begun. And the West actually is behind some of
There's
that.
no question about that. I was gonna ask about just to kind of follow on. I don't want to cut you off, Adrian, but what do you see as the reason for this? Because I agree with you, the West is far behind. Until about May, I think our ETFs were hemorrhaging gold in Europe and North America, and only through that middle part of this year have we started to see ETFs in the West buying gold again. It's really been central banks and Asian retail investments that have propped this gold market up at all-time highs for like 4 or 5 years now. And I think now we're just starting to see the West get involved. Why do you think that is?
So basically there's a couple reasons. One, we've got things like Nvidia that we're paying attention to, right? And not to get into an equity analysis of the company or anything like that, but when there's the ability of investors to choose sort of quick moving, potentially explosively upsided types of equity assets, then the idea of a potentially slower, smaller, even though very secure purchase of gold to augment what would be considered an alternative asset class in many portfolios just happens to look less attractive. And one of the things that's interesting about the equity market in general in the US and where alternative assets have been and where they're going to go to and have started to go to is that even when the Fed was raising rates from March 2022 through basically July of 2023 in different bits, the equity market, after it got over its sort of initial fear of what high rates could be and how fast they could grow and what the Fed was really thinking and all these other sorts of
Yeah,
things,
2022 was a bad year, if I
it
recall.
was a bad year. But once the market sort of said, all right, let's take a look at what's happened in the past. In the past, when there have been financial crises, existential crises, yeah, COVID crises, the Fed and other central banks steps in, brings rates down, and pumps or prints or electronically creates a lot of money in the system. And so once it sort of processed that information, what we saw was equity markets in general, led by some of these major equities, because that's where the big ETF buying is, that's where the big asset management companies come in, and retail kind of comes along with that. And so does media attention, and that kind of has its own effect and everything else. We started seeing the equity markets also hit record after record after record. And some of these stocks within these equity markets, they had been beaten down by more than, say, gold was beaten down. So the snapback was much greater, and the potential for quick returns was much higher, and it did accelerate much higher. It was like a self-fulfilling prophecy because that's where all the money was going. The expectation, which we are now seeing because the Fed is now back into rate cutting mode, which it kind of always was accommodative, but it still has a $7 trillion book of assets of printed money in return for debt assets. The market started feeling okay with it, and that's why, again, all this slush of money started going into things that weren't alternative assets. And that was the choice of many of these Western ETFs. So you took money out of alternative assets, precious metals, other kinds of real assets, and you basically pivoted them into technology, into some of these other types of asset classes. That's one of the reasons why we kept seeing record after record in the stock market as well. And so now what's happening is there's a bit of a rethink. Where is that return going to come from? And are we really going to get 4x, 7x, whatever X returns in the next Nvidia or in a multiple of them? Or should we consider other forms of long-term growth related assets like gold?
Gotcha. Looks like we lost Adrian for a second there. I know they were having some issues with power in Puerto Rico. Oh, here he is. He's back. While he's reconnecting, I was just going to follow on there. I've been hearing now for 4 years, and people on this webinar series have heard me say repeatedly. Those that read our newsletter have heard me write repeatedly. Those at conferences have heard me say from the stage repeatedly that gold at all-time highs is dirt cheap, and silver at 40%, 50% of all-time highs is even cheaper. Okay. And I see that very clearly. I've seen it consolidating for 4 or 5 years. Things don't consolidate for 4 or 5 years to go down. their building support to go much higher for a whole multitude of reasons. My big question here is I understand that the money was flowing into equities in the West. We're at all-time highs there too. I mean, you know, it was one year we were making like 33 new all-time highs in the Dow, and yet money was still flowing there. And yet I've heard for 4 or 5 years when it comes to gold that it's like, well, I'm going to wait for the pullback. It's expensive.
Right.
Why is that? Do you
It's
know?
it's really interesting psychologically, and what we are seeing with respect to gold and now silver catching up and still way off of its highs, is that there's a bit of a rethink, but it's taking some time in the West. And I think a lot of that, I mean, it goes back to Wall Street, right? I mean, I spent a lot of time on Wall Street. I you know, am in touch with a lot of people who've stayed on as well as moved on from Wall Street and so forth. And the reality is the mentality from an equity perspective is that there's always a way that you're going to pick some potential stock or some set of stocks or something like that if the money is cheap enough where basically you can make it happen, not you personally, but as a larger institution, as a multitude of institutions, a collective and so forth. And one of the things that we saw is after the markets had such a tough time in the wake of COVID, and also while they were sort of trying to process what the Fed was going to do after that inflation period post-COVID, there was a bit of confusion amongst investors, and there was a bit of time that it took to go back into the equity markets. Now they had come down a lot more than gold had, and this is basically what we're saying, right? Gold has that stability factor that even if it, and particularly now that we have so many other factors that are both resurging and also being fresh into the gold arena that are keeping gold where it has been on records and will continue to push it higher. In equities, what really works, particularly in technology equities, yes, the story, yes, the narrative, yes, the crowd, yes, the Wall Street crowd, but also that ability to monetize really, really cheap money. And when money started getting a bit more expensive, there was a bit of a concern, but then there was this figure, well, the Fed's going to ultimately cut rates or do something in a crisis again. So it's going to be relatively cheap, and we have it, and we basically can use it more quickly. And that looks better. It's a greed mentality when ETFs can attract so much more retail or so much more institutional or so much more pension fund or whatever it might be investors, because there's the ability to look at equities going up by 10x or 5x or 4x or whatever it is, then the attractiveness of gold over the same period of time is just less appealing, which means from a fee basis, from an asset management growth perspective and everything else, all the big players that are making these choices are almost having to bet on the equity market because it's much easier to push around because it's really paper than it is to push gold up. You know, gold is a scarce asset, as is silver, as is copper, as is uranium. These are scarcer assets. You can potentially manipulate the market, but you can't really get your weight behind pushing the market. It's much easier to be in equities, especially the major equity companies.
No, absolutely good point. And if I may, sorry, my internet went out again there. One of the joys of living in paradise. Yeah, I hope you haven't already mentioned this. You kind of hinted at it just then, Dr. Prins, you just hinted at it. And that is that so much of the money in the equity market now is from 401s and IRAs. And of course, 401 money is, you know, the person puts in money, the company matches it. It's just an automatic matching. So long as you're employed, that money continues to go into 401s. And I get a lot of my clients, as you know, you can reallocate where that goes. But I get a lot of my clients ask me in December or January, well, okay, where do you think I should put my money this year? And this is what they're offering. I have never seen a gold fund or commodity fund on that list of offerings. Right. It's, you know, big cap US or maybe global value. Gosh, emerging market if you're really, really, really lucky. But most of it is just going into the US stock market. And the choices are big cap or small cap or maybe value. And there's a bond fund as well, of course, normally. But never once have I seen a gold fund offered. And so people just say, well, I'll put it here, I'll put it there. And, you know, the money just continues to go in. I mean, I really think, you know, that's one of the big reasons why the market is up and gold isn't. The other factor, and you talked about, you mentioned fees. got to be careful what I say here since I manage money. But, you know, if I put 20% of our clients' account into physical bullion and another 10% into cash, I can guarantee you that clients will call and say, why am I paying you fees to hold gold for 20 years? And so there is a natural inclination, there's a natural inclination on the part of a manager to do things that are not going to elicit that response. I don't mean we do it deliberately, but subconsciously it's there. I think it's worth pointing out to people but gold has actually outperformed the S&P
Yes.
this century.
Thank you.
Since
Thank you.
1999, gold is up more than the S&P. And then if you look at gold stocks, this will floor people. But if you look at gold stocks, the XAU has outperformed the S&P for the last 6 months, it's outperformed year to date, it's outperformed for the last year, it's outperformed for the last 3 years. You would never know that from listening to the Main Street media.
Just
Anyway,
to put some numbers on that, Adrian, you know, so we just did this math. We got an alert coming out tomorrow. The S&P 500 since, you know, December 31st, 99, with reinvested dividends, I want to say is up 517%. Gold's up 811%. It's not even close. It's not even close.
But you would never know that.
Never know.
I think, you know, to put gold, let's just say someone put 100% of their money into gold in December 31st, 1999, and just held it, again, they would have outperformed the S&P. But what investor could tolerate just having all his money in one asset and just doing nothing? What broker could tolerate his clients doing that? What financial media could tolerate talking about that every day? Well, hold on to your gold, guys. Nothing else to say today. And so we're always looking for excitement and something to happen. Anyway.
The one part of that question we didn't touch on, I don't think, unless I missed it, was you touched a little bit at the end, was the gold miners. I think it's going to get interesting as well for gold miners here now that we've started cutting rates too, because there's a little bit of history there, right?
Yeah, so there's a couple things with gold miners. One is that, you know, as Adrian mentioned, gold miners have actually done quite well this year. They're not at where they were at for example, in 2011, when gold miners and gold kind of moved lockstep. They've rallied and they haven't rallied to that extent. Some have, and it's important to note that there are certain miners that have done a lot better than other miners, and that relates back to finances, and that relates back to where there's opportunity in miners to continue to have upside because rates are coming down. So what we had was a situation where a lot of mining and a lot of projects that were potentially more costly to begin with into COVID had to either close or, you know, for physical reasons, logistics reasons, individuals, instability in new financing or whatever it might be. Not a lot. The big ones, you know, were doing fine, but there was a lot of volatility in the markets. And as gold's coming back, as gold and demand is pulling the miners back, COVID's gone, rates went up for a bit, and that also stifled some of the forecast, the financial forecast for certain companies in terms of reprocessing or getting back into new mines or buying new mines or et cetera. So we started to see a lot of merging of mines at that time rather than new types of processes and new types of digging. But now that rates are coming down, now that the cost of financing is actually decreasing as well, while gold has reached historic highs, and while we have all these other pulls that are bringing gold up going forward geopolitically and from a currency diversification spectrum, a lot of these miners, the good ones, are going to be catching up and I think surpassing that differential that we saw in 2011. So if you look at the mining index, as Adrian mentioned, last 6 months, it has gone lockstep with gold. Not every miner, but in general. But it's not at its highs. It's actually half of its highs on total.
Oh.
And so there is a phenomenal, you know, again, as with equities, as with any equity, any company, you want to do your homework. You want to examine what their financials are like, what their management is like, what their projects are like, what their longevity is like, what their philosophy. All of that needs to be taken into account. But in general, you have this massive pull for so many reasons now going forward with gold. You had, to an extent, some roadblocks in financing or producing mines that are basically now coming back on. And then again, you have to look at the specifics of the miners themselves. And there's just a phenomenal amount of upside there. And I would argue more upside with the right ones than NVIDIA getting to those additional multiples from here, or whoever the new NVIDIA is, which I get tons of. I'm not going to go through names, but I'm sure, Adrian, I'm sure, you know, get tons of stuff through your email about, oh, this is the next NVIDIA. You know, you just get it. They're like, everything's the next NVIDIA. But the point is that what gold has done and what silver has done, and we haven't even, you know, gotten too far into that yet tonight, is really on the back of so many more real factors, as well as these miners who are now also going to be looking at reduced financing costs. And that's a really positive recipe going forward.
Absolutely.
Better profit margins. too.
The
Yes.
other point, if I may, you mentioned the price of the gold stocks today compared with the highs in 2011. The other thing I think is very important is that typically at the beginning of a gold bull market, when gold bottoms at the beginning of that bull market, the gold stocks tend to exhibit significant leverage over gold itself. And I think back to 1976. Or 2000, for example, after gold bottomed, gold was up something like 12% in the first 3 months. The gold stocks were up 50% in the first 3 months. I nearly said this time is different, but I didn't. I stopped myself. This time is unusual. You know, if you look at year to date, gold is up, what, 29%, and the XAU is up 31%. That's year to date. So the gold stocks have outperformed gold by the smallest of margins possible. That is a very unusual scenario. Again, typically they exhibit leverage of 2, 3, 4, fourfold in that beginning phase of a gold bull market. There are reasons for that, which you talked about at the beginning, which is where's the buying come from for gold and why are people buying? And central banks are not buying because of a macroeconomic environment in the US. Chinese savers are not buying gold because of a macroeconomic environment in the US. And until really a couple of months ago, that environment in the US was actually not attractive for gold at all. You had high interest rates. You had apparently low and declining inflation. You had an apparently strong stock market, a strong economy. You had a strong stock market. That's exactly the wrong environment to be buying gold. But of course, that is all beginning to change now. And you alluded to this, Rich. I think we're now beginning to see the start of what I would call the more traditional gold bull market. So, you know, when people think that this market's at the end, I don't think they could be more wrong.
In fact, I said as much in tomorrow's alert, that they are completely mistaken if that's their analysis of where things are right now. I agree with you. This is an unusual situation. I won't say different either. The fact of the matter is we've had the benefit of 4 or 5 years of all-time highs without Western investors in this market.
Sure.
That gets me beyond excited as a gold dealer, I got to tell you. Nomi, do you have anything to add to that?
No, I'm nodding at what both you guys are saying, and also, yes, from the standpoint of dealing gold, we have had absence, you know, for the reasons that we talked about, for other, you know, equity assets and things that were being looked at by the Western investor, as well as not mining companies, but other companies. And the reality is, throughout all this, of course, as we just discussed, gold has held in. And what is exciting to you as the dealer, and Adrian, to you as an asset manager, I'm sure, and to me as just a sort of geopolitical onlooker, and looking at where the trends and where what I call the pulses are actually happening, is that when you have so many reasons beyond a balance sheet to move an asset, and then you look at the companies that have to actually produce that asset as the demand continues to increase,
Sure.
and they have no choice but to be, you know, to fill that gap. And Adrian, you mentioned leverage, that's exactly right. Not every gold miner is leveraged the same way, meaning they have different ways of working their books, and we get into the details of all of that, but that make some more leverage to the upside of gold than others, while still managing conservatively their general book, their overall book. So again, it depends on who you're looking at. But
Sure.
in general, that leverage, if you match that with the appropriate business philosophy, can be incredibly powerful. And as a result, the fact that Western companies or Western investors who don't tend to look at gold and still consider it an alternative asset class. Now, here's another disconnect, right? So it's still considered an alternative asset class, right, Adrian? It's not something that when you talk about your 401k with your Fidelity advisor or something even comes up in conversation, let alone silver, let alone copper, let alone uranium, let alone palladium, let alone other things, right? It's still considered alternative. But into this world, the BIS, the Central Bank of Central Banks, again, as I mentioned before, has basically said, no, this is a high level asset in the global financial community, which is way bigger than any one asset manager. I mean, some asset managers are very, very large. I mean, BlackRock. But the point is that in
Adrian
general,
Day, for instance.
and Adrian Day, like, leverage up to BlackRock, of course, but it's there are other factors beyond investing choices and labels that we're kind of still operating under here in the West, and particularly in the United States, which are really behind all of these other shifts that are happening for gold, for precious metals that have had long time use values, as well as currency values, as well as now more geopolitical values. And it's the same thing with silver. It's actually more interesting with silver, because silver actually there have been times where silver has actually outperformed gold from the standpoint of being used as a currency. Gold is the big one, but there have been periods in time. But the point is that silver has lagged gold. I mean, we're now at 32. We're nowhere near the highs in silver, 32 and change. But what's interesting about silver is you've got other geopolitical reasons and shifts that are happening that are lifting silver. For example, India, which is also a gold buyer. Back in the day when central banks bought gold, which was into the 1920s, India Central Bank was actually the biggest holder of silver in the world when central banks were nascent things. Actually nascent in the United States, not necessarily nascent globally. But the point is, the Swiss held and the UK held silver reserves in general, as well as whatever they held from a other money perspective, right? But now you also have India's demand for for silver, just in the last 6 months, has eclipsed what their entire demand for silver was all of last year. And they are the third largest importer of silver from other countries that mine and produce silver. They've got a bunch of reasons. It's not necessarily just a hedge in their central bank, although if you're such an importer of silver, you got to be thinking of adding some silver to your gold reserves. But also, there's energy reasons, right? They are also the third largest solar energy source of power base in the world as well. They need silver to create solar panels. They need to get it from the outside. And these are really big numbers. We're talking tonnages of additional silver, not like a little bit of buying around the edges. So again, you have all of these other sources, which will ultimately relate down to pushing up miners, but that are in play for so many different reasons. And I think historically, we haven't really seen this before, all of it happening at the same time.
Right, correct. So as we know, silver has a lot of industrial uses. You touched on the solar panels, but it has a lot of industrial uses, certainly relative to gold. Does that concern you at all if we're heading into a recession in the US? And we haven't talked about that yet, but if we're heading into a recession in the US and maybe a global slowdown, does it concern you for silver?
It's a good question. It would concern me if I was looking at a 10-minute horizon sometime many months from now, right? So right now, I see the silver trend as consolidating and then moving up. We've been flirting sort of with that $30, $31 range. We've sort of gone past that. I think the upside is there. And I think for reasons of its companionship with gold, but being cheaper, its ability to also be a currency hedge, its ability historically and legally to be in reserves at central banks. It is not a tier 1 asset yet, like the BIS just made gold, but it has that path. All of these reasons are why the need for silver and therefore mining of the silver are going to increase. If we have economic slowdowns along the way, if we had a massive global slowdown for a significant period of time, then, for example, India might decide to not use solar panels or not build them or not require that additional trend in imports in silver that it's had this year going forward. Yes, that can happen. I'm mentioning India as just an example. But I think that a lot of the industrial uses, what happens with investors who have a short-term outlook is that they do look at some of these economic factors, and the markets will do this on any given day, and it can beat any given miner on any given day or mining company stock. But the markets will say, look, the economies are slowing down, so therefore the logical conclusion is all building will stop, all manufacturing will stop, all long-term industrial projects will halt, and really, aside from COVID, and something like that can happen. I mean, we can have a meteor hit some part of the world, things can stop, there can be exogenous events that happen, but net of that, we're talking about long-term economic projects that require actual real assets that happen to come from the actual ground, in addition to all of their currency and other uses. So it would concern me if my time frame was very, very short. But when I look at mining, when I look at assets, when I look at real assets, when I look at where the world is going and the countries that are driving that need and all the different uses for these assets, it's hard for me to find, aside from emergencies, like really COVID-y type things, long-term reasons why that demand's going to stop. We can have, I would think, some buying opportunities if there's volatility in those prices. But if I'm looking at things long-term, and you have to in mining, and you have to with precious metals, you have to with these kinds of assets. You have to look at all of the reasons why they are being driven up and why that demand is there. And one of them is the economy, but it is just one of them. And I think these are investments you have to be patient with. I actually had an interview earlier today with someone who is way younger, sorry guys, but than all of us. And we were talking, maybe not way, but than me. But basically, his point was that, well, it seems like if I was going to do that thing that Adrian noted that financial media doesn't like to do, which is just do that one investment or just do those couple of investments, that looking at the long-term horizon, real assets are a place to be. And that mentality from someone just coming into this industry, watching, analyzing, dealing, asset managing, this whole financial, sort of consolidation of roles is really interesting to me.
Right. It's not normal for sure. Silver's kind of interesting in that, yes, central banks can own it, but they really aren't. They're not the buyers of silver. Typically it's industry. And yeah, even though we haven't seen that push from central banks, and I'm going to screw up these numbers, but they're fairly close. I want to say there was a surplus production of silver for like 11 straight years, massive amounts of above ground silver. And in the past 2 or 3 years, the offtake has eliminated 11 years of surplus in just like 2 or 3 years. So the demand is there. It may not be from central banks, but there's no question demand is there. My only concern about silver is, especially when gold starts to take off, this year, percentage-wise, silver's outpacing gold right now in terms of price appreciation, not by much, but it's starting to flex its muscles, although it's a bit more volatile. But a lot of people will get into silver as that poor man's gold, that substitute for gold in a rising market of monetary assets. And it tends to be more speculative, which is not that firm grip investor, it's that weekend investor. And that's the only thing that concerns me a little bit about the silver market.
Right. The other thing, if I may add to what you said about silver, it's really interesting to me. We all talk about the industrial demand for silver, but we forget to look at the same time as the changes that have happened to the supply picture for silver. And I'm the only one here old enough to remember, but 40 years ago, something like 75% of the silver production was from primary mines.
Mhm.
That's a
Today,
good point.
it's a maximum of 30%. I think it's less than that, but the Silver Council says 30%. Now, that includes mines that are 50-50 gold silver.
Mhm.
So the vast majority of silver production is byproduct, and it is byproduct of copper, yes, but also tin,
Mhm.
lead, zinc. So it's a byproduct of industrial resources. So as the economy slows, you get less industrial demand, but you also get less supply of silver, not because a miner, a lead miner in Peru or a zinc miner in Bolivia is cutting silver production, but just because they're cutting production of lead, zinc, and tin, and the byproduct silver goes down. So, and it's interesting to me, if we know all about the industrial supply factors, the industrial demand factors, but if you look at the price of silver on, as you said earlier, not on a 10-minute horizon, but on any kind of long-term horizon, you look at the price of silver, and it correlates much more closely to monetary factors than it does to industrial factors.
Mhm.
So as Rich said, it can be more speculative, so it has sharper spikes, but in broad terms, it acts like a monetary metal. It doesn't act like an industrial metal.
Can I just throw one last thought in there from my side on silver? I'm not a technician, but I've seen circulating some of these 45-year silver charts. Have you seen these? With the cup and handle formation, a
Yes, yeah, yes,
45-year cup and handle formation.
yes.
I can only begin to speculate, the massive potential upside of a 45-year cup and handle. So that's to be
Yeah.
said for silver's favor as well. We'll see how that plays out.
And
Hey,
just
can I jump in? Sorry. No, go on.
just the cup and handle for anyone who isn't sort of analytically looking at the names of everything. I mean, just it is what
It
what
looks just like cup and handle.
it is, a cup and handle. I mean, it is definitely pointing to a long-term increase in the value of silver, and by all of those measures. And I think, yes, it behaves on a monetary basis. That's been its history. But I also think that we're at a different kind of other transformation in the world that's sort of bigger than what we've seen industrially, and whether that is solely in the energy sector, which I think is a big part of that, but also how AI technology, everything that we are producing today or needing tomorrow requires more and more power and energy power.
Yeah.
And silver, just by default, because of its conductivity. I mean, same with copper, same with other types of permanent magnet. Rare earth elements too will pop into that equation as well. But it has use value, where those uses are also expanding over time. And so I think I think that's going to have another component. It's not going to be a straight line, but there's definitely more and more need for silver that still needs to be mined, and from mines that actually are in areas where it's easy to access that silver, easy to transport that silver. And that just goes back to, if we're looking at the commodity and the producer, the miner of the commodity, to do that homework.
Absolutely. Hey, Rich, can I jump in now? Obviously the people who signed in to listen to this are more important than you and I. Should we take some of their questions? Because there's a lot of questions there. What do you think, Rich?
Yes. Oh, you froze. I missed you. You froze. Can you restate that one more time?
No, I was saying the people who signed in are more important than you and I.
I agree.
And their questions are more important than your and I questions. Should we take a few questions from some of the listeners?
Yeah,
What do you think?
let's do that before we pivot to another currency, the US dollar.
Sure.
So I want to
That's what
go
I was
there
thinking.
probably next,
Yeah.
but let's touch on some of these. So Jeff's been very patient right off the bat. He said, while in classic terms, gold is viewed as a hedge against inflation, in reality, the price of gold seems to be closely coupled with interest rates. Has the latest gold push, $1,800 or so, to now been in anticipation of the rate cuts we're seeing now? If so, is that price today fully discounting how low rates are going to be? This is a tough question to answer because it's there's some guessing going on. But what are your thoughts there?
So it's a great question because we kind of opened with this a little bit, but there are reasons for this current increase to around, these records that we've had even before rates were cut, which was that we did have an inflationary environment. We did have the anticipation, yes, that rate cuts were going to happen. And the dollar, for the most part, kind of stayed in a range. We didn't really have the decline in the dollar that expectations of rate cuts would generally produce. And we're going to talk about the dollar, I know, and I think a lot of that hasn't been actually baked into the dollar yet. And there were other reasons that the dollar kind of stayed in the range and is starting and has over the last several months been weakening. So I think a part of that increase, and this is why there's been the increase and those reasons, and there's the future reasons. Part of that increase, yes, was on anticipation of rate cuts when the return that bonds give because rates are lower is becomes less because rates are reduced, then the value of alternative assets that don't give you interest, like gold, become more attractive as alternative investments. You're not clipping that coupon, as they say on Wall Street. You're not getting that interest rate. You're not getting that interest rate on your savings account, which most banks didn't keep up with, where rates were, and savings accounts would really pay that well. But the point is, you're not getting as much for your money as you might in a bond, or you might in a sort of money market or savings account. And so when the expectation shifts, which it did pretty quickly, that the Fed was at some point going to be cutting rates, yes, that mostly pushed the equity markets up, as we were talking about before, and to an extent also is one of the factors that brought gold up to where it is now. But I think that's only one of them, or basically that combination. It's one combination of factors. And I think what's not fully priced in, the other part of your question, what's not fully priced in is what actual rate cuts can ultimately do to the strength or to weaken the dollar, because that's something that we haven't really seen yet. Mostly, it's down about 5%, but we haven't really seen it yet in this cycle. Whereas we do continue to see diversification against the dollar, against U.S. Treasuries, as we touched on a little bit before with respect to central banks, and also BRICS and other currency blocks or trading blocks that are trading outside of the dollar. So I think some of it, yes, but a lot of those old factors haven't yet been factored in.
Yeah.
Gotcha. Anything you want to add to that, Adrian? Yeah.
Yeah. No, I agree with everything you said. It's a great question because, we're always told markets are discounting mechanisms. And let's face it, it was from last December, from Jerome Powell's rather dovish press conference in December, it's been no secret that at some point they're going to cut rates, and increasingly. But, if you go back to the start of every rate cutting cycle since the mid-'80s, gold has always moved up almost immediately after the Fed's first rate cut. And none of those rate cuts was completely unexpected either. And so for whatever reason, and maybe it touches on practical issues that Nomi was just talking about, the interest rate you can get on a bank or bond or a short-term bond compared with the zero interest you get on gold. Maybe it's just that, but for whatever reason, gold has always moved, with that first rate cut. The other thing, if I may, I'm sorry, that I have to harp on one of my pet bee in my bonnet. And that is when you say in your question, in classic terms, gold is viewed as a hedge against inflation. Rich has heard me say this probably 6 times, but I'll say it again for those who don't know. There's a wonderful book written by, he's deceased now, but written by Professor Roy Jastrom. It's called The Golden Constant. And it looks at year by year the cost of living and the price of gold, and then the purchasing power of gold derived from those two. And it looks at it, year by year back to the early 19th century in the US, and then it goes year by year all the way back to the early 15th century in England. It also looks before that all the way back to the Magna Carta, but not with the precision, the year by year precision. So it looks at every year from the beginning of the 15th century. That is a long period of time that covers a lot of different economic and geopolitical circumstances. And the interesting thing is that gold actually performs better in purchasing power terms during deflationary periods than during inflationary periods. And of course, we think of gold as an inflation asset because the last big bull market in the 70s was a period of inflation. And as human beings, we always look back to the last example. That's why everybody thinks deflations are bad, because the 1930s deflation was a depression. But deflation isn't bad. I'm getting off topic now, I'm sorry, because I could talk about. So anyway, the point I'm making is that I think we need to I don't say forget about gold as an inflation hedge, because it is an inflation hedge. But there are other assets that are also good inflation hedges. There are very, very, very few assets that are good deflation hedges.
All right, I think that sums it up. Thank you both. There's a question here about CBDCs and gold. I'm going to table that for a second because after we talk about the dollar, I think we want to talk a little bit about potential gold standards, and I think that might fit in really well there. Adrian asked if one, not our Adrian, Adrian Cantwell, if one considers the efficient frontier approach to portfolio investing, what percentage of a portfolio should be allocated to gold?
Yeah, that's a really interesting question because you started it with an if one believes, because I do think there's a dynamic process behind portfolio allocation that really doesn't necessarily happen with enough in the asset in a portfolio. This is your risk profile. This is what you should do. This is what historically is the ratio between bonds and stocks, and this is therefore where you should allocate. And again, in that allocation, gold and alternative assets, as they're called, don't come into play. I personally think that you should have at least 10% of your portfolio, or even 15% in today's market, given these reasons, in a combination of gold, of silver, of copper, of uranium, and of the miners that are associated with them. Again, selecting the ones for all of the best reasons and the best in breed for those reasons. Because I think from a standpoint of efficient frontier, or simply looking at long-term stability and growth combined, these are assets that will and have proven to be useful in that capacity. They're just not part of the general arsenal of how asset managers tend to represent portfolios or tend to consider assets. They're considered commodities. They're not considered assets, really, even though they are. So sometimes alternative assets, sometimes commodities, but they're not really considered a portfolio diversifier. If we look at the Central Bank of China, they have 5% of their reserves in gold, but they are growing. And if we look at other central banks, they are more than that. And that is just that one asset class.
I tend to agree. My number tends to be 10%. And it comes from a little different space. I think others may have heard me say this before, but World Gold Council and others have done all sorts of studies where they looked at portfolios in different currencies, different stock bond mixes, and tweaking in and out different amounts of gold. And what they found, they're much brighter than I'll ever be. What they found is that 8 to 12% is kind of a sweet spot. That basically increases overall portfolio performance, decreases overall portfolio risk. And for me, a Polish kid from Jersey, the math at 10% is a lot easier than 8 and 12. So I go with 10 right in the middle. So that's where I come to that number from. And I agree, in this environment, that for me is wealth insurance. That's just, your baseline. In this environment where there's potential to profit from gold and silver too, I allocate a little bit extra as well. So I think there's room to run here.
Yeah, it's interesting you say that, just to touch on that, the difference between sort of the classic reasons why we'd even have these assets in portfolios, the inflation, the wealth preservation, all the things we talked about in the beginning, and what we are now seeing as upside for other reasons, as being that differential between what you or I might consider to be the right percentage in a portfolio versus I'm looking at increasing it right now, and our recommendations increase those holdings because all of these other external factors that haven't necessarily been calculated into the old models.
Yeah.
When you even do classical economics and you look at all these, and I built all these models when I was an analyst back on Chase, and we were looking at this new thing called foreign exchange risk back then, and these new things called options, right? And now it's all sort of part of the road. But the idea is that dynamics change. And you also have to look at the reality of those dynamics. And in general, when looking at a portfolio or looking at allocation, I think to just look at a math equation and not to look at the dynamics that are pushing some of the investments you might be making is really a disservice. And I spent a decade and a half inside of Wall Street building models to effectively not be models, or to be like, well, what if this happens and we haven't thought about it yet, and looking
Right.
at different factors, and what they would do to a portfolio, what they would do to an investment, because I think that's important. And as we've been talking about here, the world is changing and there is a dynamicism for lots of different reasons in this asset class. And that's where I think that upside from your historical percentage allocation might be to where I think it should be now because of that.
If I can just jump in, I can't help
Yeah.
it. My namesake, Adrian, great name, by the way, started this question, as Nomi says, with if one considers the efficient frontier. I don't consider the efficient frontier. I think it's nonsense, frankly. And it's a lot of math equations and everything to make it look clever. But really, you're just looking backwards and saying, what would have happened? Well, or what did happen, rather, if you look backwards, that doesn't necessarily mean that's what's going to happen going forward. You have to look at, as Nomi says, the new, and you may not agree with quite my condemnation of the efficient market hypothesis, but you have to look at what's new. If someone very, very clever with a lot of equations were to look at the efficient market frontier hypothesis in the year 1900, he probably would have put 20% of a portfolio into manufacturers of horse buggy whips. Well, that didn't work out so well going forward. So, I mean, yes, the past is very important, and we'll get onto that in a minute. I believe very much in that, but the efficient market hypothesis and what percentage should be in any particular asset really depends on whether you look at 5 years, 10 years, 20 years, 100 years, and it'll be different answers. So, but I do agree with the conclusions, 10% more or less in physical gold, or as close to physical gold as you can possibly have, for insurance purposes and wealth preservation purposes, is probably the ideal for most people. More if you have a very high risk portfolio, and less as you get older, as your need for insurance declines. But that's just for insurance. I mean, I think for investment purposes, it would go way beyond that right now.
Good point. I can't argue with that. If it's okay, I'm going to switch to the dollar here through Adrian's question. Again, if one accepts something, so if one accepts that the developing gold bull market is still ahead of us, would that imply that the US dollar is heading much lower, or will that traditional inverse relationship no longer hold? And I'm going to add to that here. I know you said that we've only seen the dollar, pull back, about 5%, right, since middle of the year. I can tell you, I've been looking at this market, and I think you see the same things, that the dollar has been weakening for many, many years, for decades. And one example is, I hear everybody talk about, the stock market, and how strong it is, new all-time highs. But if you look at the stock market measured in gold, we haven't been to the all-time highs of the dot-com bubble since. That we're only about 60% of the way to all-time highs right now in the stock market, because the dollar is so weakened through inflation. the expansion of the money supply, increase of prices. So it's floating all the boats up in terms of value. But looking at the old index, not the BDX or whatever the heck they call it, the old school 100, it's down just above 100. It was 105, 106. We've seen that 5% decrease. Do you see that continuing? And what factors do you think are going to drive that? And it's not just because the gold price is up. There's things pushing the dollar. What are your thoughts?
So I think the dollar will decline, and as I said before, it hasn't really, this 5%, what's happened in the last number of months as the Fed's really gone into rate cuts, as there's really been more conversation about buying other assets, about central banks diversifying their portfolios, just more conversation. The stuff has been happening, but just sort of it's more out in the light. That hasn't really shifted that much more downward, the dollar, yet, but it's in anticipation of that. I think we can see the dollar decline from here by another 5 to 10% over the next year or two. That doesn't necessarily mean that the relationship with gold is going to be exactly 1 for 1, because as we said, gold has other factors that are driving gold up, not just the dollar. But what are the factors driving the dollar down? One is a major factor driving the dollar down, which isn't going to change, and in fact is going to get worse, is the amount of debt that the United States has, the 35.4 whatever trillion dollars it has now, that is only increasing. The fact that the government, no matter who this is, whoever gets elected, the government effectively has to pay $1 trillion worth of interest payments before it turns its lights on. So before it pays its power bills, its water bills, its people. There's a significant
Real overhead.
amount of money that's basically, it's a real overhead. You got to do it right, and there's a significant amount of money that's really vaporizing. In addition to the fact that the dollar is being shunned, or effectively the trade agreements, currency agreements, and other types of international shifts are happening with respect to the dollar that are going to continue to happen. If we look at the G20, which is coming up on the 18th and 19th of November in Rio in Brazil, I'll be there. One of the main conversations there, aside from general economics and the energy transformation, is about payment systems. And one of the reasons for discussing payment systems, not preempting digital, but just is the fact that the world is looking for a way to basically diversify against dollar-based payment systems. And how do you do that? By basically creating another one that other countries can participate in. So those sorts of external factors that are real, that are happening, that are being developed, that are being discussed, are all drivers of the dollar becoming less prevalent in international trade, or certainly international payment systems, which is the way in which trade gets done. Now, that doesn't mean that the dollar is not going to be a reserve currency tomorrow, or in 10 years, or in 20 years, or in 30 years, it's the main reserve currency. It will. But as the power of the dollar continues to decline from a purchasing basis, and we all know that as consumers, as debt continues to increase from the standpoint of running the country, and there's no way, no matter who's in the seat, that's going to be changing anytime soon, that the value of the dollar, the value of other countries basically lending us money to run our country will decline as our debt increases, as the value of what we can do in terms of adding to our economy versus subtracting to our economy declines because of that. And that all weighs on the dollar. So I think the dollar hasn't caught up with the fact that from a rate cut perspective, that's going to be happening. That in general makes our debt less attractive. It gives less of return, which is why, again, gold has a better comparative return than holding our debt, but also how we run the country with respect to debt. And these are real things that haven't come into effect yet with the dollar, to the extent that I think they're going to, but they're all in motion. And so I do see it weakening, and I see it weakening in again, 5 to 10% in the next year or so.
Yeah,
sorry.
No, go ahead, Adrian.
Well, I was just going to ask you, I mean, unfortunately, as you said, neither of those economic factors, which are, the huge debt we have. We used to talk about the twin deficits. You don't hear that quite so much as you used to, but the twin deficits of the budget deficit and the trade deficit were, if you have a high and growing twin deficit, that's supposed to be bad for a currency, any currency. So you've got the economic factors, and you've also primarily debt, and you've also got the geopolitical factors, the wish to diversify because of weaponization of the dollar and the use of the payment system as a weapon. Neither of those is likely to change, or do you think they're likely to change?
Yeah, it's interesting. I mean, what we saw, for example, when Russia escalated, when it invaded Ukraine, we did see a sharp increase in the value of the dollar, right? We also saw a sharp increase in the value of certain commodities that were impacted and so forth. And that was sort of that safe haven play, that in an environment that is uncertain, where geopolitical factors are involved, that the dollar, because of its historic value, because of Bretton Woods, because of 1944, because central banks do keep it more in reserve than other currencies, because they do need to liquefy their banks, because those banks need to make payments to other banks in dollars. There's all sorts of legacy reasons why the dollar in a crisis, in an acute war, in an acute situation, will have that snapback, safe haven reaction, which it did. But then there's all these other reasons that we're talking about that actually chink away at the dollar. And the more I think those two are in flux, that even if we get other crises that could cause the dollar to appreciate, we're also having this other diversification factor away from the dollar kind of at the same time. So those acute safe haven pullbacks, I think, become less acute. And that is an interesting analysis to do. It's almost like that rubber band mentality. What's the elasticity? How elastic is it? Will we jump back to the dollar? Or if we continue to go away in little bits, are we going to not snap back as much to that strong dollar here? We're going to snap back here and here and here and here, and it's going to just become less of a pullback, and that remains to be seen. But mathematically, the less that the dollar is being used, even just a little bit less every day in the international community for geopolitical or payment system or financial reasons, then the less likely it is that it's going to retain as high a strength when crises happen. And some crises kill the dollar. I mean, the financial crisis of 2008 didn't do a lot of good things to the dollar. Eventually it did, because the Fed stepped in and said, hey, we're going to swap dollars to all of you other central banks so that you guys don't have the same financial problems that we just caused you. And it was a real fake out. I wrote a whole book on that in collusion. But I don't necessarily think that when that happens, or if that happens again, it's going to have the same impact.
Yeah, yeah. No, that's a really interesting point. And you talked about payment systems slowly changing, and the same could be said about the use of a dollar in reserves. You know, that's also slowly changing. But I'm reminded a little bit of when you say that you think the dollar will still be world's reserve currency in 30 years' time. That's a long time, of course. But I'm reminded of that rather overused saying from Hemingway, you know, how do you go bankrupt? Slowly at first and then suddenly.
Yeah.
Yeah, and I think you're absolutely right that at the moment we're seeing these trends towards less use of the dollar in international payments or other uses, other currencies, and the dollar percentage in foreign reserves declining slowly. But I'm wondering if there's a tipping point at some point where it starts to happen quickly. What do you think?
I was just going to say, you know, my thought process on the dollar is this. You know, I think it's been weakening for years, but we haven't really noticed it because it was strong against other currencies. What we're seeing now is it's weakening against other currencies, right? And that's not good for the dollar long term. I absolutely agree with you, Dr. Prins, that you know, there's nothing out there to replace the dollar as a reserve currency in the foreseeable future. That nothing can step into that role, but we're definitely losing our power and our grip. There's no question about that.
And from that currency percentage perspective, like we look back at when the gold standard was taken off in 1971, I mean, part of that was related to pressures because of selling the dollar relative to gold. I mean, basically we had the international community and banks selling dollars and basically buying or, you know, converting them into gold.
Yeah.
And now we have a situation where that's not happening specifically, but it is happening around the edges by these central banks, these large entities
Right.
replacing their dollars with gold, so that process is a bit slower than what led up to that the gold standard abandonment by Nixon, and actually by bankers, a whole other story. The financial community wanted to not be more to an actual asset, but to something more controllable like paper money, which the Fed stepped in and has stepped in to do. So so it's done, and it's more slow right now, but it is happening. And Adrian, I don't know what that tipping point could look like, but I imagine if we get to, let's say, a parity, and whether that's, you know, by a large central bank like China, if we start to approach parity in the amount of dollars that they hold versus other currencies versus gold, including that as another currency diversifier, that could create a tipping point where then you just sort of sell more quickly. But again, I see that as a much longer term horizon.
Sure.
All right, Adrian, I know you had one question kind of queued up, but there's a bunch of them. I'm going through the list here, and they're backing up. And thank you all. They're excellent questions, by the way. I don't think we're going to get to all of them tonight, but we'll do our best on air. And then anything that's left over, we're going to see if we can maybe try to deal with afterward, okay, as best we can. But there's a bunch of them moving around, going back to a gold standard and or the impact of CBDCs and that trend, all kind of related. So let's do that. Let's take a look. What are your thoughts? Will we ever get back to a gold standard, a currency, a reserve currency backed in gold? And we'll kind of pivot there as well, because we know CBDCs are on the horizon and a lot of countries want that in play. What does that look like in relationship to gold versus our concept of currencies now? What are your thoughts?
I mean, no, this is good. I mean, there's a lot of elements that are codependent in all of that. With respect to a gold standard, I don't think we're going to get back to a 1971 gold standard for a couple of reasons. One is because actually what we're saying about the dollar, that there isn't that ability to just sort of turn on and turn off a full standard coming relative to the US dollar. And the Chinese currency, the yuan, basically, the fact that it was added to the IMF's basket of currencies. So the IMF basket of currencies, which is basically the backstop for debt. Not so much for reserve currencies of central banks, but for outstanding international debt. Only in the last 10 years, actually in 2016, embraced the Chinese currency. And that was a big momentous occasion because at the time when Christine Lagarde was running the IMF, she basically foresaw this as being sort of the beginning of the change in the dollar's power, in the dollar's hegemony. And China at the time was already looking at increasing their gold reserves and trying to introduce ultimately not a gold standard, but a layer of gold into the SDR, which would at least begin to get its foot in the door of counteracting or being a standard for the rest of those major currencies. And they are still pushing on that. And at the time, Ben Bernanke, well, actually, he was running into this time. So Janet Yellen was there at the time. Ben Bernanke, before that, had basically told the Fed that he was a historian, he studied the Great Depression and et cetera, and a gold standard. He's glad we don't have it, and it would basically be horrendous for the United States and the world. And so that was the Fed in the United States stepping up and saying, no, we never want to go back. And that was in part because the financial crisis that happened in China and other BRICS central banks were saying, look, we need to get off of the dollar. And Ben Bernanke knew, I don't agree with a lot of what he says based on him considering himself to be a historian, but his fear about going back to some sort of a gold standard basically was put out into the world in a paper that said that would be a bad idea. And he didn't put it out there for the hell of it, right? He put it out there because that was what he saw as being a potential to occur. And I think he was right that other countries, and this is why they're stockpiling gold in addition to diversifying against the dollar. And it's to an extent why the BIS said gold can be a tier 1 asset. You don't give that level of sort of autonomy to something new but old unless you're considering the mathematics, I think, of adding some form of a gold standard into the mix of some form of, maybe not a global currency, but a global payment system form of currency, which I see is happening, like more mathematical currency. And I see that having the potential to have a gold standard component in it. It won't be a full gold standard. I don't think we're going to get back to any central bank saying we will basically convert this amount of money for this amount of gold. And partly because gold is too valuable now, partly because of everything what we're talking about. But I can see it as being an anchor to some form of a global payment system or a global underlying currency to that global payment system, which is made easier actually by digital currencies and by the blockchain technology that underlies CBDCs. Because a lot of central banks, and in fact, the Fed is a little bit behind some of the major central banks, 99 different countries are actually looking at CBDs or different states of their own digital coins. Now imagine you've got digital coins. It's very easy to introduce a gold component or any component when you have something computerized and digitized anyway. And if you have an acceptance or a payment system that then becomes a global platform, which is currently being discussed and on the agenda for the G20, these things are slow, but it is happening. Then you have the infrastructure, the platform to both have some component of gold, to also have a payment system that also takes digital coinage or has the computerized processes to be able to do that. I think this is where we're going based on all of the development that's going on at all the central banks and a lot of the governments around the world and what we're seeing, again, just because of dollar gold and so forth. It's going to take a minute, but we actually, the Fed is behind some of this development right now. And that's actually going back to the last question. That's actually kind of negative for the dollar and positive for the currency that stands the test of time, that is the real asset, and that can act as a geopolitical stability anchor to the rest of these digital representations of other country coins, if that makes sense.
Yeah, it's kind of interesting that you say that the Fed's behind a lot of this, because I want to say like 2 Q&As ago after a FOMC meeting, question came up about CBDCs and what we were doing, and Chair Powell kind of just dismissed it like, well, we haven't even thought about that. We're not even looking at it. But go ahead.
What's interesting about the Fed has fallen behind. Is what's happened. The payment system FedNow, which the Fed had developed to be that quick payment system, instantaneous payments across the US banking community, as well as a lot of the multinational global corporations that are US corporations or US based, or for tax purposes, maybe not, but US based. And one of the reasons was to basically have a sort of digital form of a payment system into which a CBDC could be introduced. Again, once things are digital, it's very easy to add blockchain technology, or it's part of it. It's very easy to add other information streams. It's very easy to add computations of a standard versus not. So all that becomes easy when it's on one platform. They did create that. They have that. It is running. But in the process of looking into CBDCs and looking at a Fed coin, they just happen to have lagged or are fallen behind what other central banks are doing and like where they're at in their development. You look at the Swedish central bank. I was out there last summer, and they're 99% of their population is digitized anyway. It's very easy, and they're working very quickly on basically incorporating a digital coin. You start to get that, or CBDC. You start to get that around the world, and you start to have one payment system, a global CBDC, a layer of gold, and so forth. But the Fed it's kind of fallen behind that, those other countries at the moment.
And frankly, yeah, no, I agree with everything you said. One reason I think that in the US we're behind on this, and I'm not saying that's a bad thing, but one of the reasons we're behind is, in the US, people, they like their guns, they like their dollar bills. And the percentage of money that is used for shopping in the US as cash, I'm not talking about, $20,000 from the drug dealer. I'm talking about just people using cash is much higher, as you know, in the US than in most other countries around the world. It's interesting when you travel, you frequently find places that don't even want cash.
Yeah.
But the US, I'm not going to say behind, because behind sounds pejorative. I would say that people in the US are ahead in insisting on keeping onto their, dollar bills. But I'll say one other thing, if I may. I mean, I agree with everything you said, 100%. But I think it's important we realize that having a digital currency, in my view, does not replace having actual physical gold. That's the
right.
security. Yeah,
Right.
that's the security. That's the insurance.
And privacy.
And
That's
privacy, absolutely.
there's a million reasons why digital currency is bad for individual privacy. And just that idea of that data collection, once data is collected, whatever that data might be from people's accounts up through banks, up through central banks, that becomes a very potentially dangerous tool. And I think some of that's happening in the United States anyway, but from this, yeah, where we're developed, we do have still more cash, and we're still more married to cash. That said, that's unfortunately becoming harder and harder to hold on to, which is where gold, which is where silver, you cannot, we all know this, right? Like you cannot mine. So you cannot fabricate gold, you cannot fabricate silver. It has to be mined, it has to come from somewhere, it has to go through processes, and this is where and why it's retained so much value, that sheer physicality. And you can't stick all of your personal information into a bar of gold. And so all of this is why the preservation, not just of wealth or the hedge or all of that, which is a component, and all these other factors we've been talking about are key to gold, silver, and so forth, but also your own legacy, your own privacy is really also interconnected into these real precious assets.
Yeah.
We are running out of time. We've got about 9 minutes left. We got a little bit of wrap up. I'm going to kind of go through here quick. If I can find a question that we can answer quickly, we will do so. Other than that, I'm going to ask anybody who did not get your question answered live tonight, if you can resend it, because I don't think I'm going to be able to cut and paste it off the screen. If you can resend it to info@assetstrategies.com, I will circulate it to Dr. Prins. I'll circulate it to Adrian Day, and I'll try to get everybody's input if you guys are okay with that after the fact. I want to get them all answered. We're just not going to have enough time, and the sun will set on this webinar. So let me see. I saw a couple quick questions here. Are there any potential black swans that might disrupt financial markets that you see on the horizon, i.e. third-party risk in derivative markets, et cetera? And we'll do this kind of like a really shotgun type.
Lightning round. Yeah,
Lightning round, there you go.
Commercial real estate in the United States, the leverage that not just the large banks, but the regional banks, and therefore the large banks, even though they say they don't have to a real downflow in the value of commercial real estate, the collateral, and the fact that they have leveraged it. There are derivatives against this, not like the subprime crisis per se, but actually more spread out than subprime loans across the banking system. And I think if any big portfolio or derivative hedge to that portfolio blows up because the collateral goes down real quick, and there's a lot of commercial real estate leases coming up, that's going to really hurt the financial system. And that's just one. There's components of this throughout the world as well. The United States is particularly bad because we leverage a lot. Banks haven't changed; they're still too big to fail from the standpoint of the government. But that's a major.
And we're paying for them to
We're
not
still
fail
with a
for
$7
years.
trillion Fed book. We're still paying.
Yeah. No, good
There's
point.
the leverage. Sorry.
Yeah. No, go ahead.
I was going to say there's the leverage, and also, of course, as you know, on commercial real estate, there's, it's a question of what are they marked at? What's the valuation that banks are carrying these things on their books for? And often it's totally unrealistic.
Yeah. I'm very concerned about jingle mail, basically just walking away from loans, sending the keys back in the mail. And these are not small positions. I agree with you there. That's the black swan I'm looking for. Raphael asked, what would you think is a better investment at this point in time in the state of the market, gold or real estate?
That's a really good question. It really depends whether you want to use the real estate for yourself or your family, or for cutting coupon, basically rent, increasing sort of passive income, or whether you're looking at a more long-term commitment. Gold has that liquidity. I mean, we've just been talking about that right now. And I think from that standpoint, it's important. That said, you need to live somewhere. So it's a tough one. What do I see going up by more? Probably gold right now, given where real estate prices are. But you know, again, I think that's a personal decision. You want use value and you want upside.
Good point. Adrian, anything to add to that, or are we good?
I'll just say it's not just a matter of which is likely to go up, but it's also which has a better risk reward. And to me, where we are right now, I can see many scenarios where real estate may not do well, generally speaking. Of course, real estate's very, very idiosyncratic, depending on what type of real estate we're talking about, where it is, and so on. But I can see scenarios where gold will continue to do well, but real estate won't. So I would plump for gold in this current environment.
Also, I'd ask you, Rich. I mean, it also depends that, you know, real estate can incur costs beyond the value of that asset and what you're getting out of it, you know, in terms of having a place to live or to rent out or whatever it might be. Because things happen, right? Because things break, weather happens, whatever it might be. So there's a carry cost that we don't always think about when we look at the prices. But in gold, that's quite limited, right? Relative to the value, the potential appreciation and everything that we're talking about now with the upside.
There's no question. You know, and I've covered this, you know, I'm a firm believer that the first way you own gold is by taking delivery. You have to have it close at hand so it can be there liquid and responsive if you have that emergency you hope you never have. The risk there obviously could be 100% if it's lost or stolen. I mean, it's the cheapest way to hold it until it's lost or stolen, then it's 100% loss, right? Anything over and above what you need short term, you could put in the hands of professionals. And those come with various costs. You know, technology has absolutely caught up. You can do anything from, like, you know, 1% ongoing storage fees per annum to nothing, you know, with a government guarantee over at Perth. So, I mean, there's a lot of different things that are available to you in the marketplace. And clearly on gold, the carry costs are minimal at this point. So good point. And I agree with you. The liquidity. I look at real estate and gold as the same thing. They're not making any more dirt. They're not making any more gold. The difference is if you need the money, how quickly can you get in that liquid position? And gold is obviously one of the most liquid markets on earth. So
that's why the BIS has made it a tier 1 asset, actually not real estate.
all right, and the last question we'll take at this point, and I don't know if you want to do it on air or if we're just going to go ahead and put it in the follow-up email tomorrow. But one gentleman said, fantastic panel, so thank you. I'm glad. I wish we could have gotten more to the questions, but I think we did a pretty good job there. He wanted to be able to reach out, contact information for all the panelists. Typically tomorrow, for everybody that's listening, we will have a recap email. In there, there'll be some special offers. And I'm going to go around to the panel and ask what some of those might be here in a second. But they'll be in the newsletter or in the email that comes out to you with a full link to the full recap of the webinar as well. So you can go back and revisit, you know, what we talked about here tonight. And there should be contact information in there. But I'd kind of like to go around, starting with Nomi, moving to Adrian, and then myself. Your parting thoughts, and what is it that you've got coming out to our readers? And I got to tell you, you know, Dr. Prins has been amazing. I mean, we've known each other a relatively short time in the space of my career, but right away I saw a synergy and the way we think and deal with things. So I really appreciate all the effort you put in, and you've actually dedicated a whole week to gold. And I want you to talk a little bit of that, because if you're not a subscriber to Dr. Prins, I think you need to be. As the same way, I think if you're not an asset management client of Adrian, I think you need to be. The same way, I think if you're not a gold client of ours, you need to be. So start off with Dr. Prins. Let us know your parting thoughts, and then how people get a hold of you, and what are some of the things you're doing for the people that tuned in.
Yeah, no, thank you for that. And you know, the same. I think in general, we're all about people. We're looking at assets, we're looking at investments, we're looking at geopolitical trends, all things we talk about. But at the end, it's also to me very important to really know who you're dealing with, and to build that trust and have that trust. And I think that's important from a management perspective. It's important from how we select equities, how we select mining companies, how we select assets. So I do have a Substack now. It's Prinsights. .substack.com. We did dedicate this week to Gold Week, meaning we've had We've had essays out on gold, on the geopolitical factors, some of which we've talked about, but also explored in more depth here. We do have a premium issue coming out tomorrow, actually, which will highlight two particular mining companies that we've done a lot of work on and that actually embody a lot of what we've discussed that I think are really just good positionings for portfolio from the standpoint of mining companies coming out. We also have another piece coming out on gold this week. And so that makes space, and we had one actually the end of, we started Gold Week early. So we basically have, but when you, if you do subscribe, I was excited. If you do subscribe though to Prinsights.com, there's different tiers of subscription, but you'll be able to see some of the ones that we've had this week, as well as how we started Gold Week last week. And I do want to thank you, Rich. We've talked about having this event for a long time, and part of us having Gold Week was really to connect it to this pinnacle, really this Wednesday night, and having this conversation, and to be able to speak with Adrian here and with his insight and with his just ability to steer investments, to steer assets forward, and to have that perspective and just really be a good human. I think this is the pinnacle of our Gold Week. But yeah, prinsights.substack.com, where we'll also have an offer that you and I talked about, Rich, for our premium subscribers. It's going to be in that in the monthly issue that's coming out for them tomorrow.
Fantastic. And if they get this follow-up email tomorrow and they subscribe tomorrow, will they have access to those offers, the stock picks and the offer with?
Yes,
physical?
I mean, yes, they will be there. I mean, depending on the timing, you'll either be able to look at it, or if you've signed up earlier, like now, then it will just come into your inbox when it goes out by direct email, or you'll have to go and sort of search a bit, but you will have the access. Signing up.
And your last thoughts on gold before we move on to Adrian?
Well, I think gold's and we're seeing this. I think gold hits 3,000 after the election. I think it hits 4,000 next year for the reasons that we mentioned, and I think silver really hits 50 into the beginning of next year as we see the consolidation of central banks process the election. I think we're going to dribble up on that path, but I think we hit that at some point after the election when that's been processed, and some of these other central banks that are buying it for purposes, whether that's industrial or diversification or as a backup to gold reserves, come in. And I think the miners are going to have a real sort of upside as well relative to silver prices. So I see them in the hundreds over a period of years, but I do see them at 50 after the election, soon after the election.
Fantastic. Adrian?
Yeah, well, first of all, I just want to really thank you, Dr. Prins. You know, you and I don't really know each other that well, but this has been really fabulous. It's gone so much quicker, but I mean, I couldn't believe it when I looked at the time. And I'll also say, if I may, but I don't think we've ever had so many questions come in for any of our guests. So thank you.
And the caliber too.
Yeah, thank you for that. I'll just make a couple of comments, if I may. I'm really glad right at the end there you mentioned people, because I've always said dealing with the right people, whether it's the CEO of a mining company or whether it's someone, you know, who you know, an analyst, listening to an analyst or whatever it is, people are absolutely critical. Dealing with good people doesn't ensure the right results, of course, but it does mean you're dealing with an honest, ethical person giving it their best. And, you know, that's important for everything, for all three of us, for everything we do. And I'll just mention, Rich, I mentioned how long I've known you and your uncle. And, you know, we've recommended your firm many, many times, never once had a single complaint. And I'll say that's unusual, because normally when I recommend people, you normally get someone come back who's unhappy. And, you know, I was just reading this morning, you may have seen it, the gold IRA dealer in California.
Yeah, California, yeah.
But walked off with people's money. You know, it can happen, and it's so critical to deal with people who are honest and ethical. On gold, I'll just say one thing. To me, the big lesson of what we've talked about, what Dr. Prins talked about today, the big lesson is, first of all, you absolutely have not missed this gold bull market. And there are many, many reasons, many reasons to own gold and many reasons to buy gold at this time. that would be my parting thought. As you know, as a money manager, we're not allowed to make special offers or anything. So have to pass on that one.
Understood. How can they reach Adrian?
Well, it's adrianday.com.
Yeah, and I will tell you that he can't make special offers, but he's special. So you should definitely reach out to him. You know, you two are wonderful. We choose who we choose to relate to and to work with, and we don't have to work with bad people, so we don't. We work with the best of the best, and it's reflected here tonight. So I echo your comments right back at you. I'm going to say what I've said for probably 3 years now, and that's gold at all-time highs is dirt cheap. Silver at 60% of all-time highs or 50% of all-time highs is even cheaper. Adrian's right. You have not missed the boat. We'd love to help you get in there. I had a guy come in yesterday interviewing for a job we're looking to hire, and he turned around. I always say, "Do you have any questions of us?" And he said, "Yeah, I've got a few questions." And one of the questions was, "Why do you like working here?" And I said, "Because I absolutely love what I do, and I'm passionate about it because I believe we help people." And it's a theme that you both raised. Putting gold in your portfolio is not something I think, you know, it'd be nice to have. I think you absolutely need to do it. And by helping you do that, I think I'm making your life better. So to that end, I thank you all for joining us. Please send those questions that didn't get answered to info.asi@assetstrategies.com. And as I usually do, I'll let you know that our next guest and our next webinar will be none other than Dan Denning. I think everybody here on the panel is familiar. I'm not sure if everybody else is, but he works with Bill Bonner at Bonner Private Research along with Tom Dyson. And that webinar will be the day after the big event here in the US. So it's Wednesday, November 6th, 7 p.m. Eastern time. And I'd like to tell you that on that night, we will know who the next president would be. And I'm not so sure we will. But we look forward to seeing you there. We will be there ready to talk about it regardless. And Nomi, thank you so much for your time. Adrian, thank you for your time. And for everybody that joined us, thank you so much for sharing it with us here tonight.
Thank
Have
you.
a great night.
Thank you very much.
Thank you.
Bye-bye.
Bye-bye.